Okay, good afternoon. On behalf of Bryant's Alumni Association, welcome to today's webinar, Helping Your Business to Manage Risk in the COVID-19 Environment. Before I turn the program over to our dean and our presenters, I just wanted to provide you with some tips for today's webinar. You are all muted during the official presentation. However, we encourage you to comment and ask questions using the chat feature located at the bottom of your screen. You can direct your question for all of us to see, or you can direct a private question to one of our presenters. We will conclude the presentation and leave time at the end for additional questions. We are joined today by Madan Anavarjula, Dean of the College of Business and Professor of International Business at Bryant University. Dean Anavarjula is responsible for strategic planning, curriculum development, faculty management, and the day-to-day administration of the College of Business. He earned his PhD in International Business at Temple University and has designed and taught innovative courses in the area of international business at both the undergrad and graduate levels. Most recently, Dean Anavarjula successfully led our international business major to national ranking. We are among the top 3 programs according to USA Today College Factual. He has led a team of dedicated faculty to launch a new undergraduate program in data science, as well as our online MBA program. And now I will turn the presenter introductions over to our dean.
Thank you, Kathleen. And hello, everybody. Welcome to Bryant University led webinar, along with Professor Nick Lynch from California State, Chico. I would like to welcome you all wholeheartedly to this webinar, and it is indeed my privilege to present a dream team of our panelists. First and foremost, Professor Michael Lynch is a distinguished professor of accounting at Bryant University. He is one of the most admired professors at Bryant. He has successfully led the MS in Taxation program for many years and groomed several students towards stellar careers. His leadership in the PwC Tax Challenge program has benefited many students to gain critical knowledge of tax and auditing areas and help launch bright careers. His interests include individual and corporate taxation, and he is also the recipient of the 2020 Outstanding Faculty Award from the Bryant University Faculty Federation. So welcome, Michael Lynch.
Thank you, Madan.
Professor Charlie Cullinan. He has been a professor of accounting at Bryant University for the past 28 years. He is an award-winning teacher and a very prolific researcher. He has also taught in several prestigious universities and schools in Canada, Portugal, and China. His research interests focus on corporate governance, social responsibility, and various auditing topics. It's my pleasure to welcome Professor Cullinan. Then we have Professor Nicholas Lynch, who is a professor of accounting at California State University in Chico. Professor Lynch earned his PhD at Mississippi State University, and he holds a Master's of Science in Accounting from Bryant University, where he was the Rhode Island Society of CPA Scholarship recipient. He holds a Bachelor of Science in Business Administration with an accounting focus from Villanova University, and he has a background in public accounting firms with DeSanto Priest and in Warwick, Rhode Island. Welcome, Professor Lynch. And it's over to you, and I'm really looking forward to learning a lot about managing the business risk in the pandemic. Thank you.
All right, good afternoon. This webinar is focused on analyzing regulatory guidance and economic relief for the COVID-19 pandemic. It's based upon an article that the 3 presenters have forthcoming in a 2020 issue of the CPA Journal, which is published by the New York Society of CPAs and highlighted here. So what I'm going to talk about mainly is the SEC response to the pandemic, as well as the manager's responsibility for assessing and managing risk with a focus on the going concern assumption. Professor Cullinan's focus is going to be on the auditor's responsibility for helping to manage risk. And Professor Mike Lynch is going to be discussing financial assistance that's available to businesses of all sizes to help them manage risk with the pandemic. So on the next slide, we have a true statement, right? The COVID-19 pandemic has created it's had a very negative economic impact, not only upon US businesses, but on businesses worldwide. It's created heightened scrutiny, not only around liquidity positions, but also surrounding the going concern risk. For example, United Airlines daily revenues in March 2020 were upwards of $100 million lower than they were in March 2019. Companies such as JCPenney and Pier 1 Imports have filed for bankruptcy. Regal Beloit, an industrial manufacturer, reports that it's drawn $255 million on its line of credit. Even though it has a strong balance sheet and it doesn't intend to currently use the borrowed proceeds, it believes that an abundance of caution regarding its cash position is prudent at this time. The next slide shows that the SEC has weighed in and taken a position on the importance of disclosure given the COVID-19 pandemic. And what the SEC is asking of businesses is for specific disclosures in the accounting earnings report, as well as in investor and analyst calls surrounding the pandemic and the business response to it. In the next slide, we see exactly what the SEC is asking managers to report. So not only the current results of operations, financial condition, and cash flows that they normally report, but also specific information on the company's COVID-19 response, as well as how operations and financial condition may change in the future as the fight against COVID-19 progresses. And so the key takeaway here is that historical data may be less significant during and following the pandemic, which poses an issue, especially from an accounting standpoint, because accounting information tends to rely upon a historical approach in many factors. But to just give you an idea of the SEC's line of thinking, they state that the response to the COVID-19 pandemic is an integrated effort. It's going to involve managers, accountants, the government, investors, employees, and even consumers. And it's going to require constant coordination. To provide just a specific, broad-based example, assume a commercial laundry business. And let's assume that they provide service to a large hotel conglomerate. The more information that that hotel conglomerate can report to its stakeholders, the better off the commercial launderer can be in terms of making internal decisions for themselves. If the hotel can tell them when they expect to be operational again and at what %, the commercial launderer can make decisions like, do we take out a PPP loan? How many employees do we bring back to work? Do we furlough employees? Do we impose pay cuts? Those types of essential decisions that have a very wide impact on the economy. Businesses and supply chains are going through a period of change. Companies such as Costco and Jack in the Box are hedging. They're locking themselves into purchase commitments for meat prices and quantities months in advance. And this is something that is not common at all in that industry sector. So one pertinent question is, how do businesses communicate forward-looking information to stakeholders, specifically in the accounting earnings report? We all understand that forward-looking information is tough for managers to convey because it involves judgment and it involves estimates. And that also makes it tough for CPAs to audit. The next slide shows us that there is some good news along that front, because FASB already requires managers to perform a forward-looking assessment of liquidity, and both PCAOB and AICPA standards require the CPA to audit managers' assessment. Of course, I'm talking about Accounting Standards Codification 205-40, disclosures of uncertainties about an entity's ability to continue as a going concern. So where I'm going to focus some time now is on the manager's responsibility to follow FASB in assessing, planning for, and disclosing any risks to the business's ability to continue over time as a going concern. And the next slide here, outlines managers' responsibility in a broad-based way. Managers must assess whether substantial doubt exists when conditions and events indicate that it is probable that the entity will be unable to meet obligations as they become due. Managers are called to make this assessment on both an interim and an annual basis, and it's a forward-looking assessment where managers have to look 12 months ahead from the financial statement issue date to determine whether it's probable. Keep in mind that that's not the balance sheet date, right? It's the date that the financial statements are issued. And in US GAAP, that term probable is defined as likely to occur. On the next slide, we see that managers' responsibility can be broken down into three main actions: assessing risk, planning for risk and evaluating that plan, and finally, disclosure. So we're going to spend a little bit of time with each of those three actions in assessing, planning for, and disclosing the going concern risk. Assessment can be broken down into three main categories: negative financial trends, indicators of financial difficulty, and other internal or external matters. Managers are called to assess both known and reasonably knowable conditions and events in aggregate. And research indicates that knowledge of COVID-19 effects on the business can be considered, should be considered, a subsequent event. Managers are going to have to assess several risk indicators and multiple scenarios. These are the three categories of known or reasonably knowable conditions and events, and specific pertinent examples of negative financial trends include sustained operating losses, negative cash flows from operations, charges or costs from impairment, reserves, or other write-downs. And managers should be careful with impairments. It is pretty easy in today's economic environment to say, I've got all sorts of assets that are impaired. But, you know, FASB really wants you to err on the side of neutrality and think long-term impairment rather than short-term impairment. So managers should be careful here not to be overly conservative and run into the realm of big bath accounting, because that would be bad. And then finally, a downturn in projected net cash flows. Pertinent examples of indicators of financial difficulty include significant workforce disruptions, such as work stoppages, a decline in customer demand, closure of stores, factories, or facilities, even if that closure is temporary, a need to significantly revise operations, a likelihood of non-compliance with debt covenants, potential or known credit downgrades, and or dividends in arrears or other changes to the dividend structure. Some pertinent examples of other internal or external matters that managers of businesses of all sizes need to think about include measures taken by governments and banks to provide relief, and that's along the lines of what Professor Mike Lynch will be discussing. Supply chain disruptions, provisions in critical customer or supply agreements that could trigger penalties or a loss of significant customers. Legal proceedings. And those last two bullet points make me think about business interruption insurance and the expected effect that it could have not only on the insurance industry, but also on businesses. Legislation that may jeopardize the ability of the entity to operate, such as state shutdowns, reopenings, and potentially more localized shutdowns. An uninsured or underinsured catastrophe, tightening of credit within financial markets, and or stock market volatility. So that's assessment. After the manager has performed their assessment, if the substantial doubt threshold is met, then the next slide shows that managers must develop a plan and then evaluate that plan. The plan is going to involve a multi-scenario cash flow and profitability analysis. Managers need to look to see how they can raise new capital and take a deep dive into their existing capital structure. And they're also going to need to outline cost-cutting measures and asset liquidations. Managers should be ready to discuss their plans with auditors and those charged with governing the entity. And the idea with evaluating the plan once it's developed is to determine whether or not it's probable that the plan will alleviate the existing substantial doubt surrounding the going concern of the business. The final action that managers have to take is to disclose. And disclosure can be daunting. And I think it can just be broken down to, hey, disclose what you know. And I've broken this down into 3 main bullet points, and you can read through these. The first is what to do if substantial doubt is raised but is alleviated by management's plans. In that case, the plan must be approved prior to the financial statement issue date. And as of that date, it must be probable that the plans will be implemented within 1 year, and it must be probable that once implemented, the plans will mitigate the substantial doubt surrounding the entity's ability to continue as a going concern. If substantial doubt is raised, second bullet point, and is not alleviated by management's plans, managers need to make sure there's a statement to that effect. And then finally, that third bullet point shows some specific disclosures that are necessary, whether the plan alleviates the substantial doubt or does not. The next slide starts to get away from managers' responsibilities to assess the risk surrounding their going concern assumption. And that's all very important because there's heightened scrutiny around the going concern assumption now. For the last couple of minutes, we're going to get back to heightened scrutiny around liquidity positions and the SEC response. The SEC Division of Corporate Finance has actually issued recent guidance to help managers with the COVID-19 disclosures that the SEC would like to see. And they state that at a minimum, they would like to see them in the management discussion and analysis footnote disclosure of the accounting earnings report, as well as in investor and analyst calls. The next slide bullet points some specific, mostly forward-looking disclosures that are going to be tough for managers to make. They are going to involve estimates and judgment, and they will be tough for auditors to audit, but it needs to be an integrated effort. The SEC is saying that the forward-looking information may be more important than errors in estimation. And, you know, it's on the auditor, like Professor Cullinan will discuss, to make sure that those errors hopefully aren't materially different than the estimates. The importance of these disclosures surrounds the fact that as states reopen and businesses get back to work, we cannot expect them to get back to pre-pandemic profit levels anytime soon. And some of that is going to be an inability to meet orders just because the products are in such high demand. But a lot of that is going to be because businesses are going to have to put in place safety measures, such as protective equipment and adding space between workers that may slow production and impact profits. For example, containers at distribution centers may now take twice as long to unload. Companies that ship parts out of the country to be modified and shipped back into the country are stockpiling their inventory due to unreliable shipping, whereas before their inventory levels were very low. Increasing inventory levels can affect debt covenants, profits, and taxes. In parts of the US, companies with overseas suppliers that have shut down are now looking to fill orders domestically. And if you're taking an overseas supply chain and you're moving it here into the United States, that can drive up production costs. Companies need to be forward-looking, and they need to be on top of this, and they need to report those facts. So there is no doubt that the COVID-19 pandemic has put a spotlight on liquidity positions and created an environment of heightened scrutiny around the going concern assumption. Managers must understand the impact that this will have on their business as well as on the auditor's report. CPAs are the professionals who are best positioned to work together with managers and the audit committee or proper governance within the entity to ensure that stakeholders remain informed. Next up, Professor Charlie Cullinan is going to discuss the auditor's role in responding to the COVID-19 pandemic and the going concern risk.
Thank you, Nick. I'd like to start with sort of a general timeline and why it's particularly interesting or important this year. So the auditor's assessment happens here on the opinion date. Now, the opinion date can vary anytime after 12/31. For a smaller company, for example, a smaller publicly traded company, a smaller issuer, it might be all the way up to the end of March. And this is the timeline for issuers, by the way, for publicly traded companies. So I'm talking about the PCAOB standards here. I'll have another slide in just a sec that talks about non-issuers. And why is this particularly important? There's sort of 2 aspects of this I'd like to highlight. First, the auditor is looking out through the end of the fiscal year. Okay, so the end of next year, say 2020 there. Okay, So they're looking out to the end of 2020. And so they're looking out maybe 10, 11, maybe 9 months at the most, okay? That's a little bit different from manager's perspective, okay? So what we consider is information that's available as of when we sign the audit opinion. Why is this particularly important this year? Well, if you think about sort of the timing of the coronavirus, most of the stuff with the coronavirus wasn't known here, but it hit around this period of time, okay? So it's particularly important in this environment to consider that when we consider our going concern assessment or our client's going concern assessment isn't here at year end, because nobody'd heard of COVID or coronavirus as of 12/31/2019, but we'd all heard of it by the end of March. Okay, therefore that does bring into scope as an auditor, and it is important that the auditor's consideration does happen when they're signing the audit opinion. So lots and lots of things could have happened between the end of the fiscal year and when the auditor signs their opinion. And one of those big things is we all became very well aware, I think, of the coronavirus starting in February and certainly in March when there were shutdowns happening in the United States economy. And as indicated by Nick, the key thing, and this is the definition from the PCOB at the bottom here, will our client be able to meet its obligations as they come due without some extraordinary action? Okay, so it's all about sort of cash in and cash out. If there's some big cash out happening sometime in the next fiscal year, that needs to be considered, and the auditor needs to ask themselves, okay, will management have the liquidity to be able to meet that obligation as it comes due? Okay, the next slide tells us, has the perspective for non-issuers, and it is a little bit different here. This is under the AICPA rules, AUC 570, as it says at the bottom there. Some little bit tweaky differences here. In this case, technically, the auditor is assessing management's evaluation rather than doing an independent evaluation on their own, which is what the PCOB standards require. There's still that key thing on the opinion date, okay? We assess as of the opinion date, and of course, in this context, a lot of things have happened between 12/31/19 and today, or whenever the opinion happens to be signed. The other difference is, instead of looking out through the end of the fiscal year, you're actually looking out a full year from the date of the opinion. So there's another couple of months that the auditor of a non-publicly traded company, of a non-issuer, has to pick up on the other end. And that, by the way, is consistent with Nick's discussion about what management has to look forward to. Management looks from the issuance date, which is usually the opinion date, out through 1 year from the issuance date, okay? Now, regardless of whether it's an issuer or a non-issuer, the next slide lays out the general sort of 4 questions, that the auditor has to ask, okay? First, as of the date I'm signing my audit opinion, is there substantial doubt that this entity will be able to continue as a going concern? Is there some concern that there's an obligation management has coming up within the next 9, 12 months, whatever the time period is, and that difference between issuers and non-issuers? Is there some debt coming due? Is there some concern that the company may not be able to continue in its current form without drastic action? Okay. Then the auditor, just like management does, assesses what are management's plans to deal with that substantial doubt. Okay. The auditor assesses feasibility of those plans, etc. And of course, as Nick discussed, management has to make disclosures, and the auditor has to assess whether those disclosures are adequate. And the concern here, of course, is that management may not be, if the situation is very dire, and that may reflect poorly on management, management may not want to make those disclosures, but the auditor's job is to make sure that those disclosures are adequate for full transparency in accordance with the relevant standards, okay, so that the users can make good decisions, okay? And finally, we have the question, okay, so there is substantial doubt, management has plans, there's adequate disclosures, we still may need to modify our audit report to draw the review's attention to that. And the next 2 slides we have will actually go through each of those steps. And for each of those steps, I'll try to provide a recent relevant example of going concern disclosures or issues or auditor reports based on that, okay? So the auditor's consideration, as we discussed, is based on knowledge obtained through the opinion date, not necessarily at the end of the year. And again, this is very important this year because nobody really heard of COVID at 12/31, but by 3/31 or 3/15 or 2/28 or whatever the right day is, I think we'd all heard of the novel coronavirus of COVID-19. And of course, there's a significant chance that COVID-19 could increase the likelihood of financial stress on our clients. We all know the effect on the economy and unemployment, etc. Okay, so just as a recent example, what you see in sort of dark blue here at the bottom is a disclosure in a footnote from Dave & Buster's. They run restaurants and game rooms and that kind of stuff. And the footnote disclosure says that they actually close 100% of their stores. Well, my goodness, if you've got some debt coming due and you have no cash coming in because your stores are closed, that's going to put a pretty significant financial squeeze on you, okay? And they specifically mentioned the lockdown orders based on the COVID-19 pandemic. And they continue, they have a material adverse effect on the results of operations, in particular, cash flows. If people aren't buying meals and putting quarters in the game machines at Dave & Buster's, the company's not going to have the cash flow, which threatens its ability to meet their obligations as they come due. Okay, and notice, as Nick mentioned, the requirement in the FASB standards, ASC 204, I think it was, is the management has to look out 1 year from the date, not the date of the financial statements, but the date that the financial statements are filed, which in this case was in early April of this year. So clear disclosure there in Dave & Buster's footnotes. They do have substantial doubt, and they're disclosing that in the footnotes, and they're giving you some detail about why. And again, the auditor's consideration is based on, again, not necessarily what existed when the financial statements, the as of date, if you will, but the date that the auditor files the opinion, okay? So the next slide tells us about, okay, there is substantial doubt. There's an initial assessment of substantial doubt, which, by the way, the PCOB envisions that you should have enough information if you've done a good audit to ask yourself the question, is there substantial doubt? So there's no requirement for incremental evidence gathering at this stage, but there is a requirement for incremental evidence evaluation, okay? And then you ask yourself, okay, what is management's plan? Hopefully management has thought about this. Hopefully management has recognized, oh shucks, we've got a big debt coming due, we've got a big cash flow coming, and there's no cash inflow, not sufficient cash inflow to help pay for that, okay? So one of the things that'll be highlighted here more in Mike Lynch's conversation a little later on are what sort of government assistance may be there to sort of increase the cash inflow, okay? Among these are the Payroll Protection Program. There's a carried back rule for net operating losses that's new with the CARES Act. So management lays out their plans. The auditor then asks themselves two fundamental questions. Are management's plans feasible? Are they doable? Let's say, for example, management says, well, my plan to deal with this coronavirus epidemic and the lack of cash inflow is to sell the distribution facility I own, okay? So if you sell the distribution facility you own, the auditor would then say, well, if you sell the distribution facility, how are you going to be able to fulfill customer orders? So that may not be a particularly feasible plan, okay? Next question, okay? So let's assume the plan is feasible. Would that mitigate the concern? Okay, so let's say there's a $5 million debt coming due and management plans to sell an asset that has a fair market value of $1 million. That plan may be feasible. You may be able to sell that building without other adverse consequences for your business. But that $1 million cash inflow from the sale of a building is unlikely to allow the management to make that $5 million payment, okay? As an example here, again, in blue at the bottom, I'm trying to give examples of all these recent relevant examples. This company called KULR, they actually said they've applied for a loan of $155,000 from the Payroll Protection Program. By the way, they don't say that will fully mitigate, fully alleviate the substantial doubt, but that will help them, KULR is disclosing in their footnotes, okay? Because that'll help them to support continuing employment, okay? And allow them to keep their employees on staff, maybe doing some stuff that will help them generate cash flows in the normal revenue recognition process, okay? So the auditor asks themselves, are management plans feasible? Do they alleviate substantial doubt? And then we get on to the next slide, which talks about, of course, management's disclosures. And Nick did a nice job laying out all the sort of detailed disclosures that are necessary. Substantial doubt of going concern must be disclosed in the financial statement footnotes, okay? Even if that substantial doubt is alleviated, it still needs to be there. And the auditor, of course, has to assess the adequacy of management disclosures. The concern here is that management may not wish to fully disclose all the bad news right now, but it's the auditor's job to make sure that the readers of those financial statements have that news, whether good or bad. Okay, and you see a recent example here. The company is independent audit. This is RTW Retail Wins. They've actually postponed filing their 10K. They said, we're still trying to figure out, okay, the disclosures necessary for full transparent disclosure about how the coronavirus pandemic is going to impact this particular company. Okay, so once that has been worked out, okay, once the auditor says, okay, your disclosures are sufficiently transparent, then we go on to the reporting process, which is the subject of the next slide. Okay, so it may affect the auditor's opinion itself. Okay, so the auditor is going to add an explanatory, that's PCOB speak, or emphasis of matter. If it's a non-issuer, they're the same kind of idea. The PCOB and the AICP issues different words there. And that draws the reader's attention. Again, the going concern issue is fully disclosed in the financial statements. If it's not, there's a different type of opinion response, okay? But the emphasis of matter, explanatory paragraph, draws the reader's attention. Hey, dear reader, you need to make sure you read footnote 6, or whatever it is, in this case, footnote 2, that talks about substantial doubt, okay? And here's a quote from a recent audit opinion from May 5th for Norwegian Cruise Lines, okay? Company financial statements have been prepared assuming the company will continue as a going concern. So in footnote 2, management has disclosed what's going on. And what's going on, all of the cruise voyages have been suspended due to COVID-19, okay? And these matters raise substantial doubts about the entity's ability to continue as a going concern. So notice again, what you're seeing here at the bottom of the slide is the auditor's response if the disclosures by management are adequate in the financial statements, okay? Now, the next couple slides go a bit beyond the article itself and talk about some other issues we've encountered as I've been looking through these issues, okay? And the estimates thing is very much in accord with what Nick talked about before, where there's significant uncertainty now. There's a lot more uncertainty than there used to be. Okay. Now, historically, well, management has to make estimates in the financial statements. The auditor has to assess the reasonableness of those estimates. Okay. And the concern here with COVID-19 is estimates are much more difficult to make. Okay. Used to be okay. So we've got historical data. We have a little fudge factor of what we expect to happen. But I don't think any of us can really predict what the world is going to look like in 6, 9, or 12 months from now, and whether we'll be open or closed, or sort of where we'll be traveling and all that good stuff, which creates significant uncertainty, okay? Which makes estimates harder to make, which means they're harder to audit, okay? A couple of examples here. GSI Technology is the first one. The uncertainty, as very explicitly, has made estimates more difficult and subjective. Okay, and here's another quote from Tesco Technologies. They've actually increased their allowance for uncollectibles, allowance for doubtful accounts, allowance for credit losses. Okay, so that at this point, almost half the allowance for credit losses is their expectation of customers not paying them. So Tesco's customers not paying Tesco. Okay, because of effects of coronavirus pandemic on Tesco's customers. So again, half the accounts receivable allowance there is directly related to uncertainty surrounding COVID. Okay, so one issue is estimates. Okay, the next slide talks about filing delays. So the SEC it understands, okay, so we're in the middle of a global pandemic. It might be hard to meet the deadlines, okay, for filing 10Ks particularly, okay? So they had a release on March 25th saying we will have some forbearance, okay? If there's a filing deadline you need to meet and you're having difficulty meeting it, okay, we'll grant you an extension of up to 45 days, okay? And here's a 10K that was filed last Friday that actually took advantage of that. They say on March 24th, we said, okay, we're gonna take advantage of that order. And due to circumstances surrounding COVID-19, we're having trouble closing the books, okay? And they also say the auditor is also having trouble completing their field work. So there's two things going on. Management's having trouble closing its books, maybe because everyone's away and maybe there's documents or records at the company's facility they may need access to. And that's impeding the auditor's ability to be able to do their field work as well. Okay, so this would be something that was supposed to have been filed on March 31st. It wound up actually being filed on June 5th. okay, due to that coronavirus delay. And finally, I'd like to chat about on the next slide is probably a significant issue looking forward. So not sort of now, so much I've been talking about is now, okay? There's another issue looking forward. If we're talking about recipients of federal assistance, there needs to be adequate disclosure and presentation of all those issues. As a quick example, funds received under the Paycheck Protection Program are forgivable if at least 75% or 60. That's changed on Friday. Mike Lynch will talk about that a little bit, okay? The remainder is used for qualifying expenses, then that loan can be forgiven, so the company doesn't have to pay it back. If the company doesn't have to pay it back, therefore it doesn't need to be a liability on the books, okay? If the company has not used the proceeds of the loan for qualifying purposes or to support their keeping their employees on payroll, then it is a debt, it is a loan, and it does need to appear on the financial statements. Okay, just one final thought before I turn it over to Mike. With regard to how salient this issue is, I looked this morning. There have been 117, the going concern issue, 117 audit opinions issued over the last 8 weeks or so that specifically mention COVID-19, and 42 of them actually have a paragraph emphasizing management disclosures about going concern that specifically reference COVID-19. So this is sort of a thing that's really come up very quickly and has gained increased prominence, okay? So I'd like to turn it over to Mike Lynch now to give you a bit more detail about some of the government assistance programs.
Thank you very much, Charlie. And thank you everyone for attending today's webinar. This year, U.S. corporations raised $1 trillion in the bond market, double the pace of last year. With interest rates at an all-time low, companies are racing to issue new debt, to restructure their existing debt, to pay down their bank lines, and to raise cash to weather the pandemic. Boeing alone issued $25 billion. Recent offerings also came from Macy's, Citigroup, and Wells Fargo. But why the rush? Because there is a record number of companies currently at the risk of downgrade due to COVID-19. If a company's debt rating goes down, obviously the cost of borrowing goes up. Standard & Poor's just said that there are 1,287 issuers on the potential downgrade list, including many that have the highest AAA rating. 64% of these are COVID related. The federal deficit for 2020 is expected to reach $3.7 trillion, 101% of GDP, the largest since World War II. The Congressional Budget Office predicts 144% by the year 2049, unless Congress acts now. One of the solutions, probably the only solution, will be to raise taxes. So be on the lookout for a value-added tax, a possible federal income tax, but definitely a raise in the U.S. corporate income tax, which is currently 21%. Let's assume the rate goes up just 4 percentage points to 25. That 4 point over 21, that's a 20% increase in corporate income taxes. Just look down the road to Woonsocket at CVS Corporation. CVS Corporation is the #1 corporate taxpayer in the United States. If we were to tell CVS that you now have to pay 20% more in federal income taxes, that's 20% less than they have to pay off their debt. So I think what we can say at this point in time, debt is good, but how much debt is too much debt? And with another pandemic possibly coming about in December, where do we get the cash flows to pay off our debt? And then where do we what? Finance our operations. The numbers I gave you concerning Boeing and Macy's and Wells Fargo, all their money came from overseas. What we're doing here is we're looking today at small, medium-sized, and fairly small, larger companies, and we're looking to see whether or not they should go into a local bank or whether they should seek their financing from the federal government. Now, the CARES Act created 3 lending programs, one for small businesses, one for medium-sized, and one for larger. As Charlie mentioned, for the small business, we have the Payroll Protection Program, which is a wonderful program that President Trump actually amended last Friday. And for medium-sized companies, we have the Economic Injury Disaster Loan Program, which I'll talk about in 1 second. And then finally, which may actually be starting accepting loans today, is the Main Street Lending Program. That I've looked in the Wall Street Journal, I've looked in Forbes, I've looked in all of the major newspapers, but those laws were totally rewritten on Monday, and I can't find anything about it. But I did my research, and I've got some updated information for you. So let's take a look at those 3 programs and see what we find. Starting with one of the popular ones, which is called the Economic Injury Disaster Loan Program. And as of Monday of this week, the Small Business Administration has approved $80 billion in injury loans for 1.1 million borrowers. These loans are for small businesses, and small is defined as a company with less than 500 employees, and the company can take out a loan up to $2 million. It's a 30-year loan with an interest rate of 3.75%. So everything looks good, but the devil is in the details. When you actually look at this loan, it tells you what the loan proceeds can be used for, and it's for working capital purposes. And you say, oh, this is wonderful. I have one over here that's paying my payroll. I've got another one over here that's taking care of working capital. But as I said, you have to look at the loan documentation and find out what the monies cannot be used for. And here's just a little list. Number 1, if you take out one of these loans, you cannot use the loan proceeds to pay dividends, bonuses. You cannot make disbursements to the owner unless the owner has provided services and they're being paid compensation. You cannot repay any shareholder debt. You cannot expand the facility. You cannot buy fixed assets, property, plant, and equipment. They cannot be used to refinance long-term debt or to relocate your company. So I decided to look at the loan documents, there's 19 pages of them, as an attorney, because I know most people in the audience are CPAs, and I said, well, let me look at the same information from another angle and see what I come up with. And this is what I found. First of all, I found that if the loan equals or exceeds $200,000, it requires a personal guarantee. If someone's asking you to personally guarantee a loan, that means that they intend to come after you, and you are in jeopardy of losing your personal assets, so be very careful. Secondly, if the loan exceeds $25,000, it must be collateralized. And the thing is that the SBA takes what is called a general security interest in any and all collateral, whether it be tangible or intangible property. And what that basically means is that the borrower cannot sell, license, lease, exchange, or transfer the property without getting SBA approval first. Also, the collateral cannot be used primarily for personal or household reasons. So therefore, as far as a company car is concerned, you've got to make sure that it's not used primarily for personal reasons, or the loan is in default and it becomes due and payable immediately. Also, this is the one you have to be aware of because it's a 30-year loan. Owners need SBA approval to reorganize, to merge, to consolidate, to change ownership or change business structure. Just think about it for a minute. Let's say you're a partnership. You want to bring in a new partner. SBA approval. A partner dies. A partner wants to sell their interest. A partner wants to retire. A lot of things happen over 30 years, and you want to make sure you include all of that information in the original loan document, or you'll find yourself in default. As I said, the loan can only be used for working capital purposes, and the definition of working capital under this particular program is a little different from what CPAs are used to. I think when I looked at it, it's a bit expanded, and it's to our benefit. Let's take an example. In our article, we mentioned restaurants because restaurants are severely affected by the pandemic. And let's say a restaurant goes in and takes out the $2 million loan, and they decide they've been closed for a while. So while they're closed, they're going to put an addition on the restaurant. They can't. It's not considered working capital. Then they decide to install or expand a takeout window. They can't because it's not working capital. How about if they decide to expand or install an outdoor patio, for outside dining? They can't. What if they go inside and they try to put up plastic barriers for social distancing between all of the dining tables? They can't. So you have to be very, very careful of how these funds are used. Otherwise, as I said, it results in a breach. While I'm thinking of it, one thing I want to point out is the statute requires the Small Business Administration to make these loans up to $2 million to all applicants that can justify that they've been affected economically by COVID-19. All of a sudden, a few weeks ago, the SBA puts on its webpage that they're going to maximize the loans at $150,000, and they're only giving the loans now to people in the agricultural business with no explanation whatsoever. So that kind of surprised me a little bit there, and I didn't really expect that, and I don't know why, and I can't find an explanation anyhow. Otherwise, the 30-year loan is deferred in the first year, but what most people don't realize is that interest accrues during that first year, even though you're not required to make any payments. So when you start making payments in year number 2, you're actually paying off the accrued interest first. And also the SBA requires that you carry hazard insurance equal to 80% of the insurable value of the collateral, and that can become very expensive in addition to the cost of the loan. Here's something that the CPAs in the room will like. At the SBA's request, the borrower needs to supply, it's called the Accountant's Review Report, just to make sure that the funds are being used for their intended purpose, which is the operational working capital of the firm. So what I would suggest is if you have a client that takes out one of these loans, they should open up a separate account and use that account only for working capital purposes, such as payroll if necessary, your monthly accruals, your accounts payable, your rent, your insurance, your property taxes, and those type of things. Otherwise, you'll find yourself in default. The good thing about the injury loan is if your business does well and you decide to give the money back and pay back the loan early, there is no prepayment penalty. The next one that I'd like to talk about, I'm afraid to talk about it, it's called the Main Street Lending Program. The Main Street Lending Program was scheduled to start 4 months ago. 2 months ago, Jerome Powell, the chairman of the Federal Reserve, said, we're ready to go in a couple of weeks. On Monday of this week, he said, we're ready soon. So soon, I thought would have been Tuesday, Wednesday, or maybe today. But the Main Street Lending Program is a program to benefit some of the large corporations and other businesses. And it even qualifies if you're sole proprietor, independent contractor, self-employed, as long as you have under 15,000 employees or under $5 billion in annual revenue. So we're talking about fairly large companies here getting fairly large loans. And it's called the Main Street Loan, where you think of the mom and pop stores. And we're talking about hundreds of millions of dollars in loans. So they did revise this total program on Monday, and I'll give you the specifics in a minute. But when I was thinking of this talk today, I wrote my conclusion on Sunday. And when I wrote my conclusion, I said the Main Street Lending Program is dead upon arrival. It will fall flat on its face. Thank God that the Federal Reserve and Secretary of Treasury Mnuchin listened to Congress, they listened to the Chamber of Commerce, and they made complete overhauls of the Main Street Lending Program. So it'll take effect as of Monday of this week, but they should start receiving applications today. So I really don't think it's dead upon arrival. I think the program is going to stumble and fall, and whether or not they're able to get up and start moving forward, again, that's kind of a wait and see attitude. So I'm going to explain how it works, and then I'll mention a few things. When the Main Street Lending Program was first passed, the government gave them $600 billion, which is a lot of money. and they said, you can loan this to a few businesses, but only those businesses that have a good credit rating. They're the companies that don't need the money. So you had to show that you had a pass rating from the federal regulators, and that's the highest rating that you can get. So they've done away with that, and they've decided to take some risk and to lower the standards and also to lower the amounts that you can borrow. So basically, if you have a client that wants a Main Street loan, they can walk into one of their local banks, and they're generally federally chartered banks and savings and loans with a federal charter, and they can say, I'd like an application, I'd like to apply for one of these loans, and they can be as low as $250,000 or as high as $300 million. So you take out the loan at your local bank, and immediately a local bank will sell it to the Federal Reserve. The Federal Reserve is going to handle the loans, and they thought at first that they wouldn't be suffering any losses, but when they found out that the credit ratings have been lowered, Secretary of Treasury Mnuchin came to Powell's rescue and said, look, I will back up your losses to the extent of $75 billion. So I see more and more businesses now saying, look, I think I'll take advantage of this, but the lending bank itself has to hold 5% of the loan. And last week it was 5%, 15%, 5%, the rules change, but now they have to have some skin in the game. So they have to make sure that they're not just giving loans to anyone, selling them to the Federal Reserve, and then walk away with a clean balance sheet. They have to keep 5% of the risk on their balance sheets. So when we look at these companies, you say, well, how long is the loan going to be for? It was, last week it was a 4-year loan. This week it's become a 5-year loan. And the interest rate is LIBOR plus 3%. LIBOR is the London Interbank Offering Rate, and that is the rate that banks charge each other at the end of the day so that they have a cash reserve that can balance off with their outstanding loans. It's a very, very low rate. I looked this morning at the current rate for today for 6 months, and I think it was about 0.49%. It's a very, very low rate, and the daily rate is close to zero, if not a negative number. So it's a very low LIBOR rate plus 3%, and the loans are going to be outstanding for 5 years. So again, I think a lot of people are going to say, I think that I will enter this program, because they have what is called the new facility, the expanded facility, and the priority facility. And most of your clients will probably be working with the new loan facility, and they'll be giving loans as low as $250,000 up to, I believe the new number was $35 million. And if you go with the priority program, they start at $250,000 to $50 million, where the expanded loan program for the large companies start at $10 million, and they go up to $300 million. But I've got some major problems with the Main Street lending program. And number one, and now it's a 5-year loan again, not 4. Number one is for 12 months after the loan is repaid, and during the period the loan is outstanding, you cannot pay any dividends, you cannot have any stock repurchases, and there are restrictions on the amount of compensation that you can pay, looking at your 2019 compensation. And here's an example. If you have officers or employees that are earning more than $425,000 in 2019, their pay is frozen. And if that person decides to step down, their severance pay is limited to twice whatever their salary was at 2019. And also for any officers or employees making over $3 million, their pay will be frozen in 2020 at $3 million plus half of what they were being paid last year over the $3 million. So if they were being paid $4 million, their pay for 2020 would be $3,500,000. These companies have to be domiciled in the United States, even though they're multinational companies. Most of the business that they conduct must be within the United States, and a majority of their employees must be in the United States as well. And they have to prove and or acknowledge that they were in sound financial condition prior to COVID-19. The good news is that if you do take out a Main Street loan, you can also have a paycheck protection loan as well, but only one of them, the paycheck loan, would be used for payroll, and the Main Street loan would be used for other purposes. And the good thing about the Main Street loan is that it does not require a personal guarantee. Now, here are my problems. Even after the rules were revised, formerly the minimum loan as of last week was $500,000. Now it's $250,000. $250,000 is still a lot of money for a lot of mom and pop Main Street shops. And 5 years is a very short period of time to repay it, even though you get a 1-year deferment. And the loan will never become forgivable. So it's not a forgivable loan. But the biggest problem that I see is that if these companies already have debt on their books, and they all will, if you look at your debt covenants, you're going to see that your old bank has put severe restrictions on your ability to borrow in the future. And the federal government, if they give you one of these loans, they will not subordinate the federal loan to one of your prior creditors. So therefore, you can be pretty sure that your prior creditor will not even give you permission to take out one of these loans. And that I see as a problem. But the biggest change in this program was before it was a 4-year loan, and you could defer the first year. And then under the new loan facility, you paid 1/3, 1/3, 1/3 in years 2, 3, and 4. They've changed that for all 3 lending facilities now. I couldn't believe this on Monday when I saw this change. They're now saying you've got 5 years to pay. They're going to defer interest for 1 year, defer principal for 2 years, and then the remaining balance will be paid in years 3, 4, and 5, but it's back-ended. So you only have to pay 15% in year 3, 15% in year 4, and the remaining 70% in year 5. So if you can afford to get one of these loans, they're much better this week than they were last week. I see we're running late. The payroll protection program, as Charlie said, you would take out the payroll loan, and you had to use 75% for payroll and 25% for Charlie's referred to as other qualified expenses, which would have been rent, utilities, mortgage, and the interest on any other loan that you have. They've gone from a 75-25 split, and last Friday, President Trump signed the Flexibility Act, and he said now the split will be 60-40, so you only have to use 60% of the loan proceeds on payroll, and the other 40% could be used for the same 4 qualified expenses. A lot of people are upset that they didn't add more expenses. It now qualifies, so it's the same 4. But the major advantage is for businesses that are in cities like New York City and San Francisco, where the rents are high. Now you have 40 cents on the dollar as opposed to 25 cents to cover those local expenses like rent. Also, under the old program that existed last week, you had the loan. You still have to get your loan by June 30th of this year. They didn't extend the date for getting the loan, but instead of having 8 weeks in order to pay it out as salary, you now have 24. And instead of having till June 30th to rehire your employees, you now have till December 31st. And it used to be a 2-year loan with a 6-month deferment, 1% interest. They have now increased that to a 5-year loan. I'm sorry, I think I went a bit over, but before we go to questions and answers, I did write a tribute to Ron Makeley, and if you have a moment and if you could stay, I would love to share that tribute with you, because I know many of you are Bryant alum, and you've come back and you've been supportive of the university, and I'd just like to give you my thoughts on the departure of Ron and Katie. In 1996, at his first faculty meeting, Ron Makeley said that his goal for his first year was to listen and learn from his esteemed faculty. He did, and then he went to work. He grew the faculty from 195 to 308. Undergraduate enrollment increased by nearly 60%. SAT scores went up. Applications tripled. He added 13 new buildings. He oversaw a capital campaign that just ended that exceeded $100 million. He created a liberal arts program, and he transformed Bryant from a small business college to a university with a global presence. He elevated the athletic program to Division I status, but most of all, as we all know, he led by example. He instilled trust, morals, character, and diversity throughout the campus. Everywhere, in everyone, we felt his presence. It is reassuring to know that Ron has paved the way for his successor, Dr. Ross Cattell. Bryant is very fortunate to have a man like Dr. Cattell with such an impressive resume in academia, research, administration, and business stepping forward on July 1st to begin to move Bryant to the next level. I and the entire faculty look forward to working with Dr. Cattell. I am certain that during the next 12 months, we will share ideas and work together to prepare innovative leaders for tomorrow. In conclusion, I extend my best wishes to Ron and Katie as they enter the next chapter of their lives. Thank you.
Thank you very much, Mike and
Thank you.
Nick and Charlie. And thank you all for being here with us today. I know one question was posted to the chat, so if our presenters could take a minute and try to answer that for that attendee, that would be helpful. If you have more questions, go ahead and enter them in. You may also reach out to the alumni office, alumni@bryant.edu, and we can forward any additional questions you might have afterwards. You will also receive an email following up with a link so that you may view this presentation again, and then you'll have these very detailed slides and their advice to refer back to. Okay, if one of you want to look at the question that Adrian asked.
Yeah, is this from Joe Aiken?
No, it's the triple P question. It's
Is
from
that the-
Adrian Maurer.
Oh, okay. Is this the payroll requirement? Is there a percentage of the workforce required to receive the benefit?
Yes.
Okay. When President Trump signed the Payroll Protection Flexibility Act last Friday, it included 3 loopholes, or I'll call them 3 exceptions to benefit the employer. So under the old act, which was prior to this week, you basically had to bring back the same people. But under the new act, you don't have to bring back the same people. They don't have to have the same pay. They don't have to have the same title. They don't have to have the same responsibilities. So if you look into that Flexibility Act, you can read about that, and it gives, I think I answered your question, but the answer is no, it doesn't have to be the same people in the same percent, and it doesn't have to be the same overall payroll. Did we get that? Are we still on?
We are.
Okay.
Yes. Yes, she says, thank you. You've answered my question. Excellent. Are there
Thank you.
any additional questions?
I can just piggyback on that question and briefly add that companies, managers need to be cognizant that they're tracing the funds, right? And that is definitely something that the auditor at the very least is going to need to see, like, how is the money being used? And the government's going to want to know as well to determine whether the loan is forgivable or not. So keeping extremely good records with triple P funds is going to be very important. And I know it can be kind of a panicked situation for small businesses. You get the funds, you immediately want to start using the funds. You might not have developed a plan on how to use them. You just start dispersing cash. So just be careful, take a deep breath, keep good records.
Excellent, thank you. Well, I think that concludes our webinar for today. Again, I encourage you all to follow up with us so we can help answer additional questions, and please look at our webinar calendar for future programs throughout the summer. Thank you all.